When did Social Security start being taxed? And why has it never been fixed? Let me ask you something. Have you ever opened your mailbox, looked at your Social Security deposit, and thought, wait a minute, why is this smaller than I expected? Not because Medicare went up, not because you claimed early, but because taxes quietly took another bite. I remember a conversation with a retiree. We'll call her Linda. She wasn't wealthy. She wasn't reckless. She had a modest pension, Social Security, and a little savings she'd built over decades. And yet, year after year, more of her Social Security was being taxed. She didn't vote for a tax increase. Congress didn't pass a new law, but it kept happening anyway. Today, I want to explain how that happened, why it was never fixed, and what you can do about it. Because this isn't just a history lesson. It's a slow leak in retirement income, and frugal people hate leaks. The history, how we got here. For the first 4 decades of Social Security, benefits were completely tax-free. From 1940 through 1983, retirees received their checks without federal income tax. That was the deal. You paid in while working, you collected later. Then, in 1984, Congress changed the rules. They decided that higher-income retirees should pay tax on part of their Social Security. The idea sounded reasonable at the time. If you had substantial income from other sources, up to 50% of your benefits could be counted as taxable income. And crucial detail here, they set income thresholds to decide who paid. In 1993, Congress expanded that again. For even higher income levels, up to 85% of benefits could be taxed. Still, the intent was narrow. This was supposed to hit a small slice of retirees, not everyone. Here's the problem, and this is the root of everything. Those income thresholds were never indexed for inflation. Not once. Not in the 1990s. Not in the 2000s. Not today. They froze the numbers and walked away. The current situation. The stealth tax. Let me explain how this quietly turned into what I call a stealth tax. The IRS uses something called combined income. It's your adjusted gross income plus non-taxable interest, plus half your Social Security. That combined number determines whether 0%, 50%, or up to 85% of your benefits get taxed. The thresholds today are the same dollar amounts set decades ago. Meanwhile, wages rose, pensions stayed flat, Social Security got COLAs, inflation marched on. So what happened? More and more retirees crossed those old thresholds without getting richer. In the mid-1980s, less than 10% of retirees paid tax on Social Security. Today, it's around half, and climbing. This didn't happen overnight. It happened quietly, slowly, invisibly. That's why people feel blindsided. Why middle-income retirees feel it most. Here's something most people don't realize. This tax doesn't hit the poorest retirees the hardest. Many of them stay under the thresholds. It doesn't hurt the wealthiest retirees the most either. They can absorb it. It hits middle-income retirees hardest. People with a modest pension, Social Security, small IRA withdrawals, maybe a little interest or part-time income. One small change, a required IRA distribution, a CD maturing, a little capital gain, can push combined income over a line. And here's the nasty part. When benefits become taxable, your effective marginal tax rate jumps. You might be in a 12% bracket, but when every extra dollar also causes more Social Security to be taxed, it can feel like 20%, even 30%. That's not intuitive. That's not transparent. And it makes careful planning harder. COLAs and Medicare. The double squeeze. COLAs are supposed to protect retirees, but under frozen thresholds, they can actually make things worse. Your Social Security goes up a little, but that increase pushes more benefits into taxable income, raises your reported income, and can trigger higher Medicare Part B premiums. So you get a COLA, then lose part of it to taxes, and another part to Medicare. That's the double squeeze. On paper, income rises. In reality, purchasing power shrinks. Future consequences. If nothing changes, this problem automatically gets worse. More retirees will be taxed. A higher percentage of benefits will be taxed. And Social Security becomes less effective as a safety net. At the same time, we're staring at long-term solvency issues. If future benefit cuts happen and taxation keeps expanding, retirees get hit from both sides. That's not sustainable. And it's not what Social Security was meant to be. Actionable steps. What you can do. Now, let's talk frugal, practical action. Because complaining doesn't pay the bills. Immediate steps. Watch your combined income, not just your tax bracket. Coordinate withdrawals so one big move doesn't spike income. Use voluntary withholding or estimated payments to avoid surprises. Medium-term planning. Roth conversions in low-income years. Qualified charitable distributions after age 70. Harvest capital gains carefully, not casually. Long-term mindset. Focus on damage control, not perfection. Plan around thresholds, not headlines. Assume Congress moves slowly. Plan accordingly. This isn't about gaming the system. It's about not letting the system quietly drain you. Social Security didn't become taxable because voters demanded it. It became taxable because inflation was ignored. That's the stealth tax. Understanding it won't fix Congress, but it will help you protect more of what you've already earned. If you would like more information, check out the link in the description on the Frugal Hacking website. Frugality isn't about being cheap. It's about being intentional. And when it comes to Social Security taxes, intention matters more than ever.